Hello everybody. Thank you very much for joining us today as we introduce today's topic, turning your super account into an income stream. This video will be all about the options you have for your retirement, what you can do with your money once you are retired, and how you can actually start an income stream to fund that retirement.
Before we start, however, I would just like to remind everybody that today's session is of a general nature only, and we're not taking into account your own personal objectives, financial situation, or needs. Should you ever require personal advice, we strongly recommend that you talk to one of our qualified financial advisors. We also urge you to download our financial services guide, product disclosure statements, and target market determinations available on our website.
All right, so what are we going to talk about today? First of all, we will discuss what is a superannuation pension, how you can access your super, and what are the rules and regulations for actually starting your pension? What are account-based pensions and what options that you have available to start one? How they work, how they are invested, and finish with what happens to your super when you pass away and your options for getting advice.
So let's start with the question, what is a superannuation pension? Now, we've just got a quick definition here that we put up on the screen. Basically, a superannuation pension is a stream of regular payments made to you from your superannuation savings during your retirement. In other words, a superannuation pension is an income stream, so that's what we'll be calling it going forward today. Before we start, however, why was superannuation introduced in Australia?
In the late 1980s, the then Labor government, realising that Australians were living longer, were worried about how an ageing population would impact the budget over time, especially when it came to age pension benefits. So in 1992, the Labor government introduced the compulsory superannuation scheme we know today, with the goal that all Australians could save up over time and help fund themselves in their retirement. This ageing concern has proved to be correct over time, as in 2021, Australia had over 3,700 people who were aged over 100, and it is now forecast that by the year 2050, that number will increase to well over 50,000 people who are going to be aged over 100 in Australia by that time. At the same time, the ratio of people who are over the age of 65 compared to all working age people is going to double over the next 40 years. So what does that retirement look like in Australia today?
As of the 22-23 ABS census, there were approximately 4.2 million Australians that were currently in retirement. That's about 16% of the current Australian population. Of those 4.2 million, approximately 41% of them rely solely on the government age pension as their main source of income. So that's around 1.7 million. Now, when it comes to retirement, what is it that we're looking to do? For example, what's our life expectancy? We spoke earlier that there is currently 3,700 people who are over 100. However, according to statistics, if you are 65 at the moment, then you can estimate that the average life expectancy will be 85 for men and 87 for women. Now, the census also predicts that by 2060, more people are going to be living into their 90s as well. So you're thinking about retiring at age 60, you're looking at about 30 years of your life in retirement. So that's around a third of your life in retirement.
With that in mind, what sort of lifestyle do you want in that retirement? We have done separate videos on this topic before, but what is your version of a comfortable retirement and where is that income coming from? Is it from your savings or from an investment portfolio? Are you going to be relying on an inheritance from Aunt Mary when she passes away? Perhaps you are resigned to being one of the people that are relying on the government age pension. Or are you going to be relying on a combination of all these sources of income? For many, however, it will be a combination of superannuation and the government age pension. Finally, you may want to look at downsizing your current way of life. There is an opportunity to put some more money into your super by selling the family home or a home you have owned for more than 10 years. If you're 55 years or older and you downsize that home, and when we say downsize here, it's not necessarily downsizing the size of the house, it's downsizing the value of the house, then the government will actually allow you to put some additional money into superannuation to help you in that retirement phase. There are obviously things that you need to know about these contributions, so we do strongly recommend that you look at our fact sheet if you want some more information around the downsizer contribution.
Let's move on to accessing your superannuation. The first question a lot of people ask is, when can I retire? In Australia, we don't have a mandatory retirement age, so the government doesn't say, okay, you're 65, you're 67, you're 70, so now you have to stop work. What we do have is 2 ages where you can actually get access to the money you need to fund your retirement. The first of those opportunities is what we call your super preservation age, and that is currently age 60. It's actually a condition of release, and there are 3 conditions of release that we talk about when it comes to accessing your super. First, when you've reached your preservation age, you've stopped work and it's not your intention to work more than 10 hours a week. Second, if you've reached your preservation age and you're still working, you may need to look at this second condition of release. That is, after turning 60, you've ceased employment arrangements and you have left that employer and you have had all of your entitlements paid out and have gone and started with a new employer. Finally, number 3, you haven't reached either of those conditions, but you have reached the magical age of 65. Once you've turned 65, it doesn't matter whether you're retired or whether you're continuing to work. You can get access tax-free to your superannuation.
The second opportunity of getting access to funds in retirement is when you reach your age pension age. That is the age you can apply to receive the government age pension. The current age pension age is 67. We do another video about this topic and dealing with Centrelink. So let's move on to talk about what you can do as far as accessing your super is concerned. What can you do with your superannuation when you do access it? And what are your drawdown options? Ultimately, the answer to the first part of that question is whatever you want. It's your money and you can do with it whatever you want to do. You can access it as a lump sum or partial lump sum. You can leave it in your super account and not touch it at all. The government doesn't make you do anything with the money if you don't want to, but it's essentially your money, so you get to choose what you want to do with it. If that means using it to go on a giant holiday, then the government's not going to stop you from doing that. But remembering, of course, that you've been putting this money aside year after year to fund your retirement. So for most people, they would like to start getting money from their super to fund their retirement. And this is what we're here to talk about today. So what are those options turning your super into an income stream?
We have 3 separate options to choose from. There is what is called a Transition to Retirement Income Account, or TTR. And again, we do a separate video on TTR, so we're not going to talk about it in detail now. But basically, it's for those people who have reached their preservation age and are still working. What we will concentrate on now are our 2 income products, the flexible income and managed income accounts. There's nothing stopping us taking super as a lump sum if we want to and cashing it out. But more and more people these days are actually looking at it as providing a regular income stream in retirement. As in our working careers, we're used to being paid fortnightly, monthly, or weekly in some cases. So we're used to managing our budget from payday to payday. As we move from that working phase to retirement, we don't want things to change. Therefore, we want our superannuation to fill that gap. But what are the differences between our current super and an income stream product?
As we're working, we're actually building our retirement savings with our contributions going into our super account. Or you may have heard it called an accumulation account. These contributions are invested and are earning us a return, but these returns are taxed at 15% whilst they're in there. So when we talk about investment returns, we've already deducted out that 15%, so you don't have to worry about that day to day. But it's important to know that it's there and that it's building up your superannuation balance. Whilst we're working, except in a few particular circumstances, such as that TTR account, we can't access that money from our accounts. We're not allowed to draw that money out as it is in that building phase. But now we're in the retirement phase, we want to start drawing down that money. So we want to start an income stream. Once started, that income stream account can't receive any further contributions, so it blocks off that tap of the contributions. If you want to add further money to our income stream, we need to move the money back to our accumulation fund, add the extra, and then recommence a new income stream. One of the advantages of an income stream is that the investments are very similar investments to our accumulation funds. However, because we are now drawing that down, the government gives us a tax incentive by reducing that 15% tax that we were paying on the investments down to zero. This gives us a boost to our retirement savings during the positive years. Also, because we're over the age of 60, it is withdrawn at a zero tax rate as well, so no tax is payable on your withdrawals. There are just a couple of the differences there between the two accounts and moving between the two phases. If you want to set up this income stream, what do I need to do?
From a CareSuper perspective, we need you to have at least $20,000 in your super account in order to open a retirement income stream. That money has to be superannuation money only. It can be from your CareSuper account, or it could be from other superannuation funds as well. If you have money outside super, such as the downsizer contribution, you'll need to add that to your CareSuper accumulation account first. You also need to have sorted out any deductions that you want to make before moving into a retirement income stream. If you don't want to move all of your money across into an income stream, you will need to leave at least $6,000 in your accumulation account to keep it open.
Another difference between the accounts is our administration fees and costs. In the accumulation phase, you can see on the screen the fees under CareSuper at the moment are $67.50 per year and 0.15% of the balance, capped at a maximum of $750 per year. On top of this, there is an estimate of 0.06% of the net assets. Now that last one is not taken directly from your account, but it is taken out of the overall pool of the fund. We also have our investment fees shown here as well. If you move from the accumulation phase across to the retirement income phase, the good news is your fees actually go down. The $67.50 remains the same, however the 0.15 reduces to 0.1 but is still capped at $750. So there's a slight fee advantage in the income stream. So how does the income stream actually work?
As mentioned earlier, we have two retirement income streams, the flexible income and managed income. So let's start with the flexible income account. As we talked about before, you are going to transfer money from your accumulation account to the new flexible income stream account. It needs to be started with at least a minimum of $20,000, and you have the exact same investment options available for you to choose from. We'll talk about those more in detail in a moment. Another difference with the income stream is that once they have started, the government states you must make a minimum withdrawal from that account every financial year. We'll discuss this more on the next slide. You also get unrestricted access to your funds, meaning you can still take lump sums if you wish to. In addition, you can set up an account so that if something happens to you, it will revert to your spouse or another beneficiary. Finally, any type of income stream, the government imposes a transfer balance cap as the maximum that can be transferred. That figure is shown on the screen.
As mentioned, there are minimum drawdown payments that you have to make every financial year, and these amounts are set by the government. They are age-based and shown on the screen. The increases are designed by the government to encourage spending as we get older. Whilst there are minimum withdrawals, there are no maximum withdrawals. So you can choose any amount you would like as a payment, provided it is more than that minimum amount. When will you receive your payment in a flexible income stream? Well, as the name says, it is flexible. So you can decide on how frequently you want to be paid. We have 5 options for you to choose from, ranging from fortnightly through to yearly. Fortnightly, we pay every second Thursday, and these usually match with the government age pension payments. If you set up the application this week, it takes 10 days to process, and the first payment will be made on the first nominated Thursday after that. All the monthly, quarterly, twice yearly and yearly payments are made on the 20th of each month. We will only pay to an account that you hold solely or in your joint name, and we cannot make payments to a business or third-party account. With this in mind, it is important that before you commence a flexible income account, that you sit down and work through your needs. Do I need a fortnightly or monthly? How much do I need each payment?
The managed income is a little bit different to the flexible income. Here, we move the money into the managed income stream account. But the idea with the managed income product is that we want to try and make your money last longer. And our aim here is for it to last until at least age 90. Once again, no tax will be charged on your investment earnings, but with this account, we will determine the investments on your behalf. We'll explain this further shortly. Again, you'll pay no income tax on the payments you receive, and you'll still have the ability to make lump sum withdrawals, and any money remaining in the account, should something happen to you, will revert to your spouse or another beneficiary. One important thing I will mention with these income stream accounts is that you are not locked into them forever. If your circumstances change and you decide you no longer need these or want them, you can move the money back into your accumulation phase account with no financial penalty.
The payment rates for the managed income are only available fortnightly, and the amount that you must withdraw in the first year is set by your age, depending upon when you take that product out, as you can see on this slide. That amount will then be adjusted on the 1st of July each year. We will look at your account balance on the 1st of July and we will adjust the income, and that adjustment is usually the CPI amount. The exception to that is where that amount falls below the minimum amount that the government mandates. So then we reserve the right to increase your payments to meet the regulatory requirements. To give you a bit of an idea of how that works, if you're someone aged between 60 and 64, the minimum amount that you must take out is 4% of your balance. If we had $300,000 invested in a managed income account, 4% will be $12,000 paid out over the course of a year. For the second year of the account, we would increase that to match inflation. So in our example here, we've gone up $300, and then again in the third year and so forth, and gradually increasing over time. If you're a little bit older, say between 65 and 72, we start at 5%, which is $15,000, and gradually go up with inflation over time. These amounts will be conveyed to you at the beginning of the financial year so that you know what the changes are that are happening. So how are income streams invested?
For our flexible income, this account operates very similarly to your accumulation account balance. You can invest it all in different asset options that we have. So that is our 6 pre-mixed options, our asset classes, and also the direct investment option as well. You can mix and match these to suit your requirement. For the managed income, you have your account split into 2 streams. We have the cash portion that we will use to make regular payments to you, and then we'll also have the long-term allocation to generate the growth needed to make your money last. As you can see, it's made up of 67% growth and 33% defensive. Another important aspect of our income stream is called the retirement bonus.
This is a bonus paid to members who transfer from the accumulation phase to the retirement income phase. The way it works is you have paid up to 15% tax on investment earnings during the accumulation phase. As this tax is charged annually by the ATO, we are required to put that tax aside. When we swap from the accumulation phase to the retirement phase, there is no longer a tax responsibility on that money. So we pass those savings back to you as a bonus on your account. This bonus is automatically credited to you if you're eligible when you open a retirement income product. It does not apply to TTR accounts. You can only receive the bonus once, so if you set it up, get the bonus paid, and then have to go back into the accumulation phase for whatever reason, and then come back over to the retirement phase, you don't get the bonus a second time. The bonus is calculated as a percentage of the transfer amount, so it's going to boost your account balance when you start the retirement phase product. The current retirement bonus rate is 0.3% of the commencement balance of your account, and there is no cap on the balance. The trustee will recalculate the amount regularly based on the tax that they've set aside to pay, and so that rate may change over time.
We've spoken about nominating your beneficiaries in many of our sessions, as it's a very important part of superannuation. Even though you own your superannuation, you've given it to us to look after on your behalf. Accordingly, you need to nominate a beneficiary on your account so that if something happens to you, the trustee is able to allocate your monies in a timely manner to your beneficiaries. There are a number of different beneficiary types, including the one that applies only to income streams, and that is called a reversionary beneficiary. A reversionary beneficiary can only be paid to your spouse or partner. If you are receiving an income stream from your account and you pass away, then the income stream passes over to your reversionary beneficiary. They have the option of continuing to receive regular payments or an option to receive it as a lump sum payment. So, how do I start an income stream?
There are a number of steps that need to be taken in the lead up to starting an income stream product. We do suggest to you that you talk to one of our superannuation advisors so that they can help you through the process, and we will tell you how to do that in a moment. This is a basic process. First of all, you need to make sure that you deposit any additional monies that you want to start your account. If you've got multiple superannuation accounts, you might want to consider bringing them all together into one. Next, you either need to download the PDS and application form from our website or ring our friendly contact centre so we can post one to you. When you start completing the application, you'll need to provide your formal ID. That could be either a passport and a Medicare card or a driver's licence and a Medicare card. Copies of these documents need to be certified by a nominated person. If you prefer, we do have an electronic option available. On the application form, you can complete your details and we will do the checks electronically to make sure you are the person applying for the income stream. Once you've done all that, then you need to determine which income stream you want. Are you applying for the flexible or managed income stream? What is the payment frequency from the flexible income? What investment options for the flexible? Remember, your money can be invested in exactly the same way in this product as it in the accumulation phase. What beneficiary do you want on your account? Do you want it binding, non-lapsing, binding, lapsing, or a reversionary nomination?
But to summarise, what are the pros and cons of starting an income stream? First, investments in any income stream that you start are taxed at 0%. You are guaranteed a regular income stream whilst there is money in your account. You have the flexibility to still make lump sum withdrawals if you want to. There are lower fees payable under the income stream. You own the same investment options and you will have a residual balance going to your beneficiaries. On the cons side, there is a minimum withdrawal amount required. If you have a higher balance in your account, then remember, it's based on a percentage of that. So you may have to withdraw more than you need. If you've got two accounts, so you've got your superannuation account and your pension account, that means two sets of fees. So there may be additional fees if you are paying to have two accounts open. When the markets are going down, there is a potential of getting a higher negative return because of the tax implications. And if you're on Centrelink or getting an age pension, starting an income stream, especially if your spouse is younger than you and they have started an income stream as well, it may affect the means test within Centrelink pension. So again, get some advice before you start it.
All of this can be very confusing, and there are a lot of different things that you need to remember. So getting advice is key for a lot of people. So what are your options? If you do need advice, obviously there is information available on our website through our contact centre and our seminars and webinars, but it is only providing you with general advice. If you need personal advice in relation to your superannuation account with CareSuper, speak to one of our superannuation advisors. These are qualified financial advisors who specialise in providing advice regarding your contributions, investment, transition, retirement, pension within your CareSuper account, and it comes at no additional cost. It is part of your membership. If you want to explore outside of your CareSuper account, but just want a snapshot of how you are tracking overall, as well as getting some answers to things like, will I qualify for the age pension? What other assets have I got? Then you can sit down and talk with one of our comprehensive advice team, and they can do what we call a retirement health check. It's a snapshot that's personalised to your situation. It factors in your details to provide you with a projection on how you are tracking, and there is a cost, and that's shown on the screen. If you then want to progress further and have a look at your whole situation, a more holistic view, such as you and your partner super, investments outside of super, the age pension, tax minimalisation, etc., then you can talk with one of our comprehensive advisors. They can go through all of that for you. They will advise you how much it would cost and provide advice and assistance for you before any work is done. How much that will depend on your circumstances.
That brings us to the end of today's session. Thank you very much, everybody, for joining us. Hopefully we've given you some useful information.